Hello guys, welcome to another strategy learning session. Today we are going to talk about bear call ladder. The name is deceiving. The bear call ladder is used for a bullish view. Let's see how the strategy will look like. Bear call ladder is a modification to the bear call spread. Bear call spread is a bearish view strategy. So we are going to change this strategy to a bullish view strategy that gives us bear call ladder. So the bear call ladder is also an adjustment to bear call spread. So why I am giving this video before giving the adjustments to the vertical spread is the main reason is bear call ladder is also one of the adjustments to the bear call spread. Okay, first let us add the bear call spread. This is a sensible interface. You can go to the left side menu and then select the strategy builder. So you will get the ready-made strategies for bullish, bearish, neutral view and other strategies. So we'll go to the ready-made bearish view and we will click the bear call spread. So once we select the bear call spread, so it provides the ready-made expiry in the nearest expiry, means today I am recording it on 10th of November. So 11th of November tomorrow is the expiry. So let us not take the 11th of November. Let us go to the monthly expiry. I will give you the reason later. So we will go to the monthly expiry 25th of November. So the vertical spread, both the legs are of same expiry, different strike, same option. Okay, either call option or put option. So we are having a bear call spread, so call options. So bear call spread, just to give a small overview. If you want to know what is the bear call spread, you can go and watch the video. The link will now appear on the top of your screen. So you can click that and first watch the bear call spread. Then you can come back and watch the bear call ladder. So the bear call spread is buying a higher call, selling a lower call and buying a higher call for the hedging. If the market goes down, this strategy will provide good profits. What is the profit? This bear call spread is a credit strategy. So whatever credit you are receiving, so that credit is your max profit. Since it is a credit strategy, your max loss is higher than your max profit and you have a very good probability of profit because your break even is much higher. Since you are getting a credit, your break even is much higher. Coming back to the bear call ladder, if you have taken a bear call spread and the market continues to go up, means we have to do adjustments, right, to the bear call spread. One of the adjustment is a bear call ladder. So what we do in a bear call ladder is we buy one higher strike. The moment you buy one higher strike, the entire strategy changes. How it will change? Let us add it live and then see. Right now what we have, 25th of November, 18,000 call sell and 25th of November, 18,200 call buy. So let us go and buy a 18,300. Consider that now the market started going up and you start getting losses. See, the market tomorrow it will open at 18,150 and your strategy will start giving loss. So how to adjust this is to provide another call on a higher side so that the entire strategy changes to bullish. Let's add. So 11th of November will change it to 25th of November. And we already have this position. Let us buy one more call. See what it does. It changes the complete strategy to bullish view. On a downside, from the current level of entry on the downside, your risk is limited to the premium what you have paid. There is an upside risk in the beginning. If the market moves up slightly, you will start getting very good loss. But if the market moves above your higher buy strike, it will start giving a very good profit. So just to summarize, bear call ladder has three legs. So a lower call sell. Lower call means this is the lowest strike call, means in this strategy to sell. Then a middle strike buy and a higher strike buy. So whenever, like in this video, when I say lower strike, middle strike, higher strike, you know, means lower strike is a sell, middle strike is a buy, and higher strike is also a buy. So one sell against two buys. So whenever like your buy leg, the quantity is more, you have a bullish view, right? You are buying a call, right? Means it's a bullish view. In this strategy, when do we get our maximum loss? So our maximum loss happens when your market spot is at or between your two buy strikes. You see, your maximum loss in this strategy is 10,400 rupees. So when is the first time, when is the maximum loss will hit on expiry? When the market is at either 18,200 middle strike or at the higher strike 18,300. In between, wherever it expires, the strategy will give the maximum loss. So in between your lower strike and below, your risk is limited to whatever premium you have paid. This is a debit. Now it has become a debit strategy, right? So whatever premium you have paid, that is going to be your risk. You can consider 430 rupees. It's absolutely like no risk, right? Means you can consider this as a break-even trade on the downside, okay? But if you would have kept the strategy as it is, your bear call spread would have given profit, right? Means you are trying to eliminate your loss, right? So that is why you have made the adjustment. So on a downside, you are limiting your loss only to a very minimum, like the premium paid. On a higher side, your profit potential is not defined. It is unlimited profit. If the market by end of the December, on the December expiry, if the market goes and expires at 18,800, you can see the profit is about 14,500 rupees of profit. So your view, what you have taken initially is a bearish view. You just made one adjustment and the strategy has become bullish. Okay. This trade can be taken either for a credit or a debit or a zero cost trade. It's not zero loss. I am telling zero cost trade. Means you would be paying a very less premium or you will be getting a very less premium. Means on the downside, your loss is limited only to the premium what you have paid, or your profit is limited to whatever credit you have received. So right now what you are seeing is basically a zero cost trade. Means 430 rupees single lot is not much, because 3 legs your brokerage itself is about 40 rupees per leg two way, so 120 rupees here itself, right? So this 430 is not a big money. Let us adjust this one a little bit to see how the different scenarios will play out. So the first scenario is a zero cost trade. Okay, let us see if you are taking a credit for this. When you are taking a credit, you basically move your higher strike further higher. Your loss will be more, but your break even will also increase, but your downside risk will entirely eliminate because you will be taking credit for this position. So let us change this one to 18,400. Now you can see when you take to 18,400, the money what you have collected for selling at the money call, the lower strike call, is 222 rupees. But what you have paid for buying these two calls is less than 222 rupees, right? So when the market completely goes down, so all your call will expire worthless, and whatever credit you have received is for you, right? So this is a net credit trade. Your downside, there is absolutely no risk. You will get to keep whatever premium you have received, right? On a upper side, you can see that your break even increases, but your loss will reduce. Loss will not increase, loss will reduce, because you are paying less, right? You are still keeping the credit, so your loss will reduce, but your break even will increase like anything. Since you have a credit strategy, you will have two break evens, means one on a lower side and the other one on the higher side. But if you see the higher side, your break even will increase. Previously, the break even was lower. Let us go back to the previous one. There will be only one break even, that is your higher break even. Here the higher break even is 18,580, right? So when you go back to your zero cost trade, you can see your break even is 18,508. You have increased your break even by another 80 points if you are increasing your strikes, but you have reduced your loss from 10,400 to 9,300 only. So this one is a net credit trade. Downside, there is absolutely no risk. So two scenarios done. Let us see the third scenario. The third scenario is a net debit trade. We have seen zero cost trade. We have seen net credit trade. Let us see the net debit trade. Net debit trade means basically you will move down yourself. So let us take 18,250. Okay. 18,300 we have seen. Let us take 18,250. So when you go to the 18,250, your break even will further reduce. Before it was 18,508, right? Means for your zero cost trade. So now your break even will reduce by another 30 points, but your maximum loss will increase when your strike is very near, because you are using the entire credit what you received for buying the option, and you are paying a little bit more also. That is why in between your both buy strikes, your loss is your maximum loss, which is 11,100 rupees, right? But on the downside, below your lower sell strike, you will have only your premium as risk, because you have paid 1,135. When the market goes down, all this call will expire worthless. So when everything expires worthless, what is your risk? Your risk is what you paid out, right? Means your premium what you have paid out is 1,135. So that is the only risk for you, right? This is a net debit trade. So on the downside, your risk is limited only to the premium paid. So now I have already explained three types of bear call ladder. Bear call ladder, as a summary, bear call ladder is a adjustment trade to bear call spread. It can be taken as a standalone, but you need a quick movement on the upside to start getting profit. If it moves a little bit till your expiry, you will end up with some loss. That is why you have to provide a little higher time for your strategy to conform to your view and the market conforms to your view. Because the break evens are quite high here, right? Means now the market is at 18,000, your break even is 450 points away, right? So to get that 450 points of movement, it will not move in 2 days, right? Means you have to provide 2 weeks, 3 weeks time, means for the market to go up. If it goes in one day, it is well and good. And this one, you don't have to wait till expiry to close this, because your T plus 0, you will always get a profit if the market moves quickly above. If you wait till expiry, the strategy will give loss. Means if the market stays between this, the strategy will give loss. But in between, you will get a profit because you have a bullish strategy, right? If the market goes up before the expiry, the strategy will give profit, right? Now you have taken at 18,000, tomorrow market goes to 18,100. So you gain 100 points, right? Means see, when it goes to 18,100, at expiry it will give a 6,100 rupees loss. But tomorrow it will give 600 rupees profit, right? You can always book the profit and come out. The strategy is adjustment to a bear call spread, but this strategy can be taken as a standalone for a bullish view, because your loss is less than a regular call buy. Okay. Say you go and buy a call of 18,200. Let us say that we will keep the net debit strategy as it is. So the difference, I am trying to explain the difference between a plain vanilla call buy and a bull call ladder. Okay, it's a bear call ladder. So when we have a bear call ladder, your net loss at the downside is only 1135. Okay, you are not going to lose anything more than this if the market goes down. But you say that you simply buy 18,200 call. Okay, let us delete this 1. You go and buy 18,200 call. When you simply buy 18,200 call and the market goes down, what we will lose? We will lose the entire 6,500. But when you take the spread, but okay, here this has advantage because you are going to pay only the premium, right? There the margin will be there, so you have to pay the margin. Let us go to that position. No, let us see this also. Let us delete this. Okay. First, let us finish this. Let us not jump here and there. We'll finish this. So when you buy a call, 18,200 call, your break even is 18,331 because you have paid 131 rupees of premium. So 18,200 plus 131 will be 18,331. So that is going to be your break even. The market has to go above 18,331 for you to start making profit. Means till that point you will have loss, right? At expiry. Means if the market starts going up immediately, like when the market goes to 18,150 tomorrow, you will have about 2,500 rupees profit. Means that is a potential of buying a call, naked call. Okay, but if you wait till expiry, means all those profit will evaporate because of the time decay and will end up with loss. But your loss is your entire premium if the market stays below 18,200. If it goes above 18,200, you will start making some money out of this. Means you may not have the break even as it is, but you will start making some money out of this. Okay, but it has to be above 18,200. Means for you to make money on the call buy at expiry. Now we know what is the loss we are going to get. So let us get to the bear call ladder. So we have a bear call spread 25, 25, then add 250. Okay, this is the net debit what we were talking about. Say when you just simply buy a call, if the market goes down, you will lose 6,500 rupees, right? So now you will not lose 6,500 rupees. You will be losing only 1,135. For this, okay, you have to pay a premium here. So a margin here, but this margin can come from your collateral. Means if you are having shares, you can pledge your shares and get a collateral. Probably like you will use 50% cash and 50% in collateral. So like 11,000 plus in cash, that is what you have to use. The remaining can come from collateral. This strategy, the point what I am trying to make is this strategy is much better than simply buying a call. Okay, because your downside is protected. The downside is very small. The same way your upside potential, the profit is undefined. You have a minor loss in this small pit. Just we have to ensure that this small pit is crossed. To cross this small pit, we have to provide enough time for the trade. So today is 10th of November. So we are giving 2 weeks for the market to go above 18,472, and it goes much above that, we will start making very good profits. But if the market comes below, our loss is limited only to the premium what we paid. Since this is a spread, our payment is very less, not 6,500 like a call buy. We are going to pay only 1,135. Since the sell component is involved, we have to put up some margin for that. This margin can come from a collateral. Okay, so now I have explained what is a bear call ladder. I hope you enjoyed the content. If you like the content, please like the video, comment on it, and subscribe to our channel and share the video to your friends. Signing off, this is JR. May the markets be with you. Take care. Bye bye. Thanks for watching. If you like our content, please subscribe to our channel, like and share the video. Thank you.